Okay friends, and welcome to today's video. Today we're going to be looking at smart money concept, the fair value gap. Everything you need to know about the fair value gap. So as you all know, I've been uploading some series of videos about institutional reference points and about areas of values you can find on the charts that make you better time your entries in the forex market. So today we're going to be looking at the fair value gap and all that it entails. So as you know, I also give friendly calls in most of my videos, and it's just more like me encouraging aspiring, struggling, and traders on their journey to consistency. About the three factors I usually look at: time, patience, and discipline, or time, discipline, and patience, as the case may be. But today, I just want us to really focus on the number one factor there, time. Once you're able to master that particular factor, time, you're able to understand it, it will help you become more disciplined as a trader and make you become more patient as a trader. So you need to understand that timing is everything. There is the perfect time. There's just that right time. You get what I'm trying to say? That that setup comes, that that entry is going to really give you that result you desire. There's that better time to exit the market. There is that time you shouldn't be trading at all. You know what I'm trying to say? So once you understand the factor time and you are willing to submit to it, it's going to change a whole lot in your trading. It's going to make you become more disciplined and more patient. So just submit to time, my friend. Just submit to time. So let's continue. So in today's video, we're going to be looking at the overview, the idea behind the fair value gap, what's the point for the fair value gap, how to identify the fair value gap, which fair value gap actually holds true, how and when to use the fair value gap, examples, and at the end of it, we'll be concluding today's lesson. So moving forward, who invented the fair value gap? As you all know, my mentor ICT, Michael AUDUSD, is the one that actually came up with this fair value gap. As far as my knowledge is concerned, as far as I know, is the one I learned it from, is the one that invented it, is the one that taught it, that actually drew my attention to what it really entails and all that the fair value gap has to offer. And I'm here today to teach you because I learned it from him. So he's the one that invented the fair value gap. So moving forward, the idea behind the fair value gap: this is a location in price where smart money pairs sell and buy orders with willing participants within a price range to start a buy program or a sell program. Now, don't forget the word location there. Location in price where smart money pair sell and buy orders with willing participants in a price range to start a buy or sell program. Probably some of you may be asking, who is smart money? What is smart money? These are just small group entities of people or institutions that are the real people that actually drive price around, not retail traders. You are trying to say. If you are familiar with my content, you know I've actually spoken about this a lot. They are the 1% of the 1% that actually move price around. This is not a conspiracy theory, it's just reality. And this comprises of the central bank, the big institutions like JP Morgan Bank, CBS, Citibank, and the rest. Those top guys, you don't want to say, they are the ones that actually drive price. They offer liquidity, and they are also liquidity providers, and they move price where they want price to go. You understand? They move price the way they want price to go. So moving forward, the second idea behind the fair value gap: this is a location in price where smart money have their pending orders ready to be paired or triggered in order to re-enter the marketplace at a price perceived to be fair valued. In other words, at this fair value location in price, they have pending orders. This smart money, they have pending orders, is there to trigger to so that they can re-enter the market. Probably they didn't get all their orders filled, so they want to get all their orders filled at this particular location in price, and they can only do that at a price they know or perceive is fair valued. You know what I'm trying to say? Where if, for instance, they also enter short, they want to make sure that every existing long is already exhausted. If they want to enter short, long, they want to make sure every existing short in the marketplace is already exhausted. And the last finally is a location in price where smart money would look to go out of their long or short position at a price perceived as fair value. In other words, fair value gap can also be a location where smart money decide, okay, we have been selling for a long time or we have been buying for a long time. At this location, we're going to get out. You understand? Say they've actually reserved that location so that they can use it as a how will I put it, more like an equilibrium. It's not a midpoint, but they perceive it as an equilibrium. I'd say, for instance, if they're on a long position, they perceive it as price as an area where price is too high. You know what I'm saying, to continue buying. And if it's they are selling, they perceive it as a place where price is too low to keep selling. You know what I'm saying? So they exit their long or short positions around those areas of value known as fair value gap. So moving forward, what's the point for the fair value gap? Now, probably some of you may be thinking, why do I need this fair value gap? Why should I even incorporate in my trading? Why do I even need to listen to you, Isaiah? Am I sure that you are not part of those people coming up with new ideas in the trading industry to move people around and siphon their monies or make people lose their money to mislead them? Aha, friend, I got a real deal for you. This is an area of value or a location in price that acts as an area of support or resistance for institutional minded traders. So you got it now. So the point for the fair value gap, it acts as a support or resistance. Yes, retail minded traders want to draw support and resistance. They either draw an horizontal line around their chart, thinking that these are places that price will hold on to, and most of the times they fall into prey with things of like when I'm saying they want to catch a breakout from that particular horizontal resistance, they fall into the traps of false breakouts and the rest. You get why? Because it's just an horizontal line, and that horizontal line is not respected at all. You know what I'm saying? The institution are not looking at those horizontal lines. That horizontal line only exists on your own chart. It doesn't exist on the bank level. They are not saying that there. You know what I'm saying? They are either looking at a fair value gap, an order block, or other institutional reference points that I'm going to be teaching you very soon. You know what I'm saying? So they are not looking at any other thing other than this institutional reference points, this area of values, these locations in price that I'm talking to you about. This is what they are saying. This is what they are is making them say, okay, here's a support, here's a resistance. So fair value gap act as a support or resistance for institutional minded traders. So if you are an institutional minded trader just like you are now, welcome to the club. Here is your support, here is your resistance. Moving forward, how to identify the fair value gap. Like what you can see right here on the screen is the bearish fair value gap. So what should you be looking out for? You want to see 3 candles like this, 3 candles forming this pattern. First, you want to see this particular first one form, and when you see this particular first one form, you want to see the next one form, the second one, and the third one. So when this third one is forming, you don't want to see this particular high over this region trade to this particular low. So that's why I outlined these lines here, telling you, you want to see that this low over here and this high should not meet. Why? So that once it doesn't meet, it creates what we know here in the midpoint of this particular 3 candles. It forms what we know as the fair value gap. So it says, I outlined it here, the fair value gap. So what we price will come back for this area later in the future as either as a resistance level. You know what I'm saying? As a resistance level, because this was looking here at the bearish fair value gap. So price is going to come back here for a resistance. So once you see this kind of pattern, I don't want to use the word pattern, but to help some people, that would be nice to use. So once you see this kind of pattern, you know what I'm saying, this 1, 2, 3, and this particular low here and this particular high does not meet, creating a gap at this middle candle here. What this is seen as is a fair value gap. The idea is simply that price traded from this particular line here to this other line. Price traded one side, one direction of the market, and in this case traded bearish, traded down. You know what I'm saying? So price will later come up, you know what I'm saying, to fill in that area. Why? Because that's the market efficiency paradigm. You know what I'm saying? It's an efficiency in the market. The market is efficient in nature. It's meant to see that for every down candle traded, there must be an up candle traded back into it. For every up candle traded, there should be a down candle traded into it. So that is market efficiency paradigm. So for this is the fair value gap. Moving forward, what we have next here is the bullish fair value gap. The same concept. You want to see three candles just like you are seeing right here. And I say, mind you, the colors of the candle is not respected. It could be three candles straight. It could be three bull candles, three green candles straight up. You know what I'm trying to say? But the idea behind the fair value gap is that you want to see three candles form, and that once the last candle form, you don't want to see the low. In this case, for the bullish fair value gap, you don't want to see this low get back to this high. And once this doesn't happen, the midpoint here, you know what I'm trying to say? The midpoint showing that this particular middle candle traded only one direction, which is in this case upward. This particular thing lit a gap here, and that is known as a fair value gap. You know what I'm trying to say? So from this low to this high, this midpoint right here is the fair value gap. Why? Because price traded higher. And for market efficiency paradigm, price will have to trade back lower into that gap in order for market to be efficient in nature. So this is how to identify the fair value gap in a bullish or bearish market condition. Moving forward, which fair value gap actually holds true? There are a lot of fair value gaps formed every single day and on all time frames, especially on the lower time frames. So you may ask, which fair value gap is worth my attention? So probably you might know what I want to say now, and that is the daily, weekly, and monthly time frames. So the higher time frame fair value gaps are actually the fair value gaps that actually hold true. And why? Because I've seen a lot of people say this smart money concept doesn't work, this blah blah blah. But the problem is that they spend time looking for these things on the lower time frame, like the 1 hour, 15 minutes, 5 minutes, and the rest. The truth is that you could be looking at a bearish fair value gap, but in this case, the market would have already set its tone to be from the higher time frame to be bullish. You know what I'm trying to say? So if you're looking at the bearish fair value gap on the 1 hour, what do you think? Market is going to defy that fair value gap or that block in any institutional reference point you're looking at. So that's why you get a lot of losses. Why? Because you are ignoring the higher time frame. Because these are where the institutions, the banks, the smart money, they actually fill in their orders. This is where you see their orders. This is where you see what they are doing. You know what I'm trying to say? So when you look at these time frames, any institutional reference point should have a value, at least to a particular degree of value. You know what I'm trying to say? So you want to focus on the higher time frames when applying these smart money concepts. So how to use a fair value gap strategy? Number one, once we identify the fair value gap on the higher time frame, the next thing we want to see a retracement or pullback to our fair value gap already was identified. The next thing we want to see is that we want to see price trade above the high of the last candle. We want to see price trade above the high. You want to say the high or the low, rather. I forgot to put that there. The high or the low. It depends on which case we're looking at. If we're looking at the bullish fair value gap, I want to see price trade below the low of the last candle. If it's the bullish, we want to see a bullish the bearish fair value gap, we want to see price trade above the high of the last candle. You know what I'm saying? And after that, immediately we want to see a price show a willingness to leave that location immediately. In this case, a fair value gap. So let's go see some examples. So right here, as you can see on my chart, this is the euro card on the weekly time frame. You know what I'm saying? And you see those shaded areas on the chart, those are fair value gaps. So without further ado, so we don't waste our time, if you look right here on this place, you see 1, 2, 3, the 3 candle. And what happened? This low did not trade back to this high right here. So this validates this area as a fair value gap. And what do you see? You saw price straight into it, even on the weekly time frame. And what do you see? A response higher, giving us even 12,000 pip. So you could frame your setup right here using this fair value gap. The next, just right above it, is another fair value gap. And even right here, you can see clearly that there's a gap even immediately after this middle candle. 1, 2, and 3. And from this low to this high, we saw that market was not efficient right here. We didn't see this low gets to this high. So this validates here what a fair value gap. And what do we see? We see price straight into it. There is a clearing minus, say just going below the low a little, which is what we got here, and price traded higher or to here, giving us 5,800 pips. A whole lot of money that you'd have grabbed for yourself if you understood the fair value gap concept. And now, just for the sake of showing you that retail minded things won't have worked, I want you to keep your eye at this region right here. So let's say some retail traders will draw the horizontal line right here. You see, once price was trading low, what would they expect price to drop into the horizontal box, right? But you see, it didn't get there. Why? Because there was a fair value gap right here. So it ignored it and bounced off. Even when it tries to come down here, it just came down from this for this low, for this double low here, bottom low here, and what expanded higher. So let's say you are too precise, you are too perfect, you want it to drop into this particular location of yours, in this case your support horizontal line for retail minded traders. That wouldn't have worked. That would have been a failed or missed opportunity. So that's just to tell you that horizontal lines doesn't work all the time. So you can switch a little from what you know to this over time. It's not compulsory, just switch once. Let me say you are a retail minded trader and use that horizontal support every time. So let's just move forward. Right here we have the last example here for the bearish market condition, for the bullish fair value gap. So we have 1, 2, 3 price trade just right below this low here and expanded higher. So it wasn't much, but it gave us 3,700 pips. That was a whole lot of pips, brother. That's a whole lot of pips just right here. So you see how it works, and immediately later on breaking down for this order block right here. You know, it's a breakdown for that order block. So I just want us to see, just drop to the lower time frame to see how would have capitalized on this move on the daily time frame. So that's just the lower time frame right here. So that's right here. Let me see. So price dropped into it, created an order block here. So this would have been your entry right here, giving you 2,000 precise move. Or you'd have waited for price to trade back into this order block, into the high of the order block, and you'd have entered. Or you'd have waited for this lowest price here, just into the order block, just below the mean threshold a little. You want to say, okay, just past the mean threshold, and say coming for this double bottom here, and that would have been your entry right there, giving you 3,015 pips. So that's a whole lot of setups, even using the fair value gap. So let's take a look at another example. So the AUDUSD, one of my favorite pairs that I like to trade. So if you look at this particular pair, I shaded some areas. And for those of you familiar with my content here on this channel, just recently analyzed that the AUDUSD is on a bearish tone in the marketplace, and I was able to arrive at that. Why? Because of this particular fair value gap I'm discussing in this content. So for those of you that don't know about that video, I'm going to be leaving a link to that video somewhere around here in this video or in the description, so you can access the video to see how I analyze that. So just draw your attention right here. Here, 1, 2, 3, the fair value gap. This high did not get towards this low here. So you see I shaded that area. So I arrived at that this region was going to go in a bearish tone down to 72,900 around this area right here, and I was able to arrive there because if you draw this down to this particular area in time, you see that price wicked into that fair value gap right there. You understand? Price wicked into just right above this high, the high of this candle. Why? Because price traded on one side, and based on market efficiency paradigm, for the market to be efficient, price has to trade back. You understand? Trade back, closing in that gap. You understand? If I go on the daily time frame, you're going to see right here, price had to trade back. You understand? To cover that gap. You understand? To be in order for the market to be efficient. You understand? So if you also look at this particular location here that I shaded to, you can also see rather that we have a fair value gap 1, 2, 3. So we see that this high did not get to this low right here. The low is not obvious. You understand? But if you draw that out in time, you're going to see right here that you're going to see right here, sorry, you're going to see that price traded into that gap. You're going to see just right above this high over here, above this high. Why? Because market has to be efficient. What do we see? We saw price trade down, you're going to say, into this order block on the weekly time frame. And if we drop down to the daily, we're going to see a perfect entry right there. So right here we saw a rejection, right here, and price traded down where into this weekly candle right here, or this order block right here. The case may be, depending on what you are looking at or what you can see clearly in charts. So you can see that the fair value gap works like magic, you understand? So it works efficiently. So that was how I was able to arrive at the bearish tone in the marketplace for the AUDUSD, even using the fair value gap. You understand? So the fair value gap is one institutional reference point, or one location or area of value in price, depending on what you like to call it. You understand? That really offers great reward potential. Like, I'm going to also be dropping a video about this weekly analysis, how we arrived at this particular location in price. You know what I'm saying? How we arrived at this particular location in price, where price traded to the 72,900 we outlined in the analysis for the bearish tone of the AUDUSD. And also I also analyzed last weekly analysis, how we traded it in the bearish side. I get to at least I believe to the 73,450 level or thereabout. And say, so the fair value gap works like magic. So this is how institutional trading actually works. You want to pay attention to these areas and locations in your price. Why? Because they offer a great deal of a lot of setups, and they form, once you can see them clearly on the higher time frame, it's easier for you to bank on them, that they will likely pull through and give you great reward setups. So thank you very much for watching today's video, and see you in the next video. If you find value, make sure you hit this like button, and if you're new, also make sure you subscribe. And thank you for watching, and see you next time.